Okay, hi guys, hi everyone. I hope you guys can hear me. Let's just give about 2 minutes so that we can admit everyone into the chat and we won't be distracted during the class. Okay, I know I promised you after 2 minutes, so here we are today. Okay, I'm not sure if you already know me or not. Okay, so my name is Vanisha. I've been teaching FM for ever since I've been a lecturer. Okay, and today what we're going to do is we're going to go into we're going to talk about working capital management. It's going to be a very interesting class because what we're going to do today is we're just going to have a refreshing class. So I just want to remind you guys, okay, this is not the place where you learn 100% of the knowledge. Okay, this is the place where you get additional knowledge on top of what you already have from your education throughout June until now. Okay, so I'm going to give you the best of what I can in the next 2 hours. Okay, um, if you want to ask me any questions, please just do it in the chat box. I will read the chat box from time to time because I'll be teaching at the same time, so it will be a bit difficult for me to keep addressing questions. But just to remind you, just put it down in the chat box whenever and whatever questions that you have. At the time when I read the chat box, I will address each and every question. So don't worry about those things. So let's start. So today we're going to talk about working capital management. So I'm not sure how many of you are comfortable enough to do a working capital management question without getting stuck. To be very honest with you, to be very frank with you, it is simple. It is something that can be done for as long as you do multiple questions. Why? Because for this particular chapter, there's something that you need to remember. This chapter is one of those areas that will be tested in your section C. So there will be 3 areas of the F9 syllabus that will be tested under the section C of your examination. Section C means the structured part of the examination. So this is one of those areas. Now you need to remember working capital is simple because all the questions in the working capital management of your F9 or your FM examination, it has been repeated. That means it is something that you will be able to achieve a saturated point if you do it multiple times. So all you have to do for a working capital management question is you need to do it multiple times. Okay, now one thing that I need to remind you, if I am going too fast, please stop me. Let me know if I'm going too fast so that I can slow down. I have the tendency to go a little bit faster, and the fact that this is just a refresh class, you know, you want to cover a lot of things. So yeah, let's see how that goes. Okay, so for the first part, I'm going to introduce working capital to you. Okay, so to introduce working capital, the first question that you should ask yourself is whether you know what is working capital or not. So the first thing that comes to your mind when you talk about working capital is the formula. Obviously, everyone knows the formula: current assets minus current liabilities. So I'm sure you guys, since you are at this level, you know what a current asset is and what current liabilities consist of. So I'm not going to go into that details, but I would like to ask you. So I want to make it more interactive. I hope you guys can talk to me a lot more. So I'm going to ask your opinion. What is it that you understand from the formula of CA minus CL? Because you just remember the formula CA minus CL. But what is it that you understand from the formula of current asset minus current liability? Anyone? You can type it in the chat box as well. Let's see whether there is anyone in this class who is brave enough to come up and answer. No, no one? Come on, guys. Okay, resources left after settling on obligations. That is the exact answer that I'm looking for, because what students fail to understand is the meaning of current asset minus current liabilities is that the amount of resources, because your assets are all resources to your company. Why are they resources? Because you can liquidate your asset in turn for money. So because you have the ability to liquidate your asset in terms of money, therefore current assets are your resources, and your liabilities, your current liabilities, are the short-term obligations of the organization. So once you have liquidated all your current assets, you pay off your current liabilities. What is left is the amount of funds that can be used for you to then run your organization. So generally, when you want to talk about working capital, you need to remember that you need to have a sufficient liquidity status in your company for you to be able to run your company effectively. That is why when asked to define working capital, you actually say that working capital is the capital, or you can also use the word resources, of a business that is used in the day-to-day trading operations. That is the amount of funds that you require in your company to run your existing operations. Okay, it also is a measure of the company's efficiency and short-term financial health. So why is it a measure of the company's efficiency? Because if the company is able to maintain current assets that is higher than the current liability, meaning they have more resources in the organization, that means they are able to run the organization in such a way they have surplus resources, which is what you aim to achieve. You need to have surplus resources in your organization so that you are able to run the organization effectively in case you need funds or resources on an ad hoc basis. The fact that you have more current assets, more resources, more capital, more funds, you are able to serve the ad hoc purposes of your business requirement. And why is it also a measure of the short-term financial health? Because if your current asset is more than the current liability, that also shows that you manage your liabilities and your assets well enough that you have sufficient access resources to run your organization. So if I ask you to give me examples of current asset, current liability, generally you should already know that under your current assets, you have inventory, you have trade receivable, okay, you have cash in bank, you have all those other prepayments and all that. And then you have current liabilities. The common ones that we use are trade payables and overdraft. Okay, so now When you talk about working capital, there are two main objectives that your working capital tends to want to achieve. So what are those objectives? So the objectives are the profitability objective and the liquidity objective. When you talk about profitability objective, what are you aiming to achieve?
Maximizing shareholder wealth.
Sorry, I can't hear you.
Maximizing shareholder wealth.
Yeah, okay. You want to achieve maximization of the profitability of the shareholders' wealth. Okay, so here you want to ensure the organization is able shareholders' wealth, or you can say the profitability of the company. And when you talk about liquidity objectives, okay, what you want to try to achieve, what is the objective in terms of liquidity? Anyone? The liquidity objective? Okay, someone said to support the day-to-day operation. What it means is that you need to have sufficient liquid resources in order for you to run your day-to-day operations. When I say sufficient liquid resources, what I mean is that I need money that is readily available. Okay, that is what it means by liquidity objective. So as for the liquidity objective, you need to have sufficient liquid resources to run your day-to-day operations. Because if you have sufficient liquid resources, that means you have sufficient money in your organization, then you are able to meet your daily obligations as well. Okay, but the problem is that for you to be able to achieve these two objectives, you need to let go one of them. Why? Because if you want to achieve the profitability objective, what do you need to do? You need to be able to invest excess resources. Okay, remember the term I'm using here is invest excess resources. Why is it that investing excess resources can lead to you not being able to achieve the liquidity objective? So any liquid resources or excess money, I hope you can see if I write here. Okay, as for the profitability objective, profitability, I don't know why am I writing profitability. Okay, so as for the profitability objective, okay, you need to be able to invest excess resources, because investing excess resources will earn the company a return, and this return will then help to maximize shareholders' wealth. But the problem is that if I invest my excess resources, what will happen is that my company now is less liquid. Why do I say it's less liquid? Because in order for me to achieve the liquidity objective, I need sufficient liquid resources in my organization. I should not put it in an investment. The problem with investing your excess resources is that when you invest your excess resources, these resources now, it is stuck in the investment. Let's say for 3 months. If your money is stuck in the investment for 3 months, are you able to use this money to run your day-to-day activity? No.
No.
Right? You are not able to use this money to run your day-to-day activity. Why? Because it is stuck in the investment for a period of 3 months. So for the 3 months, you will be lacking of a certain amount of cash. So there often is a conflict between the liquidity and the profitability objective of working capital. So the best way for an organization to manage these two is they need to ensure that they are able to balance the profitability and the liquidity objective. That is very important for an organization. Why? Because in order for them to be able to achieve their objective, they need to ensure that they balance the profitability and liquidity, because you don't want to have too much liquid resources where your liquid resources is not serving any purpose, right? You just keep the money, keep the money, but the money is not doing anything. It's similar like you take your money, let's say you have 1,000 ringgit, you take 200 ringgit, you say you want to save, okay? But you must save smartly. You cannot just save in your home cupboard. If you save in your home cupboard, are you earning any interest? Are you increasing the 200 ringgit that you kept? No, your 200 ringgit is just going to be 200 ringgit forever if you don't do anything with it. So the smart way of increasing your money, the value of your money, is by putting it in a place where it can increase your returns. Okay, so earning interest example. Okay, so that's why you need to balance these two objectives. So examiner often asks you this. He will ask you, explain the profitability and the liquidity objective of working capital and how it conflicts with each other. So you must know how to answer that question. So I don't think nowadays, because you are doing CBE and your exams is meant to be a little bit more difficult now, because you're moving towards that era where your exam is moving to all strategic level papers. So I don't think he will ask you something as simple as define profitability and liquidity objective of working capital, but it is more of him asking you, how do you explain the profitability and the liquidity conflict of working capital? So I have this answer here that you can use. I'm going to give it to you. This would help you. This is a very generic answer. So with this answer, if you take down this answer, it will be much easier for you, because over time, when you do questions, you will see the 2 or 3 questions that are similar, very much similar to each other. So you can use this answer to yes. So this will be an answer about 4 marks, a 4-mark answer. Yeah, if you want, you can take it down. I'm okay with it. It's a very generic answer. Whatever question he asks you about profitability and liquidity objective, and also the conflict between the 2 objectives, you can use this answer. No matter what question. The only thing that probably you must do is, wherever I put a company, maybe you replace the company name. So of maybe PKA Co, example, okay, or another company name, let's say VV Co. Just replace the word company with the company name. Then you're set to go. Do you need some time to copy this? Because if you don't, then I will just move on.
Done.
Done. That was fast. Okay. Okay. So the next part of your working capital, the introduction to working capital, is the cash operating cycle. Okay. When you talk about the cash operating cycle, the first thing that you need to understand is that the cash operating cycle does not have or does not consist the cash the word cash in your cash operating cycle formula. Okay, it is, you first need to understand what is the meaning of a cash operating cycle. The moment you understand the meaning of a cash operating cycle, you will know why they did not include cash in the formula. Okay, so the cash operating cycle is the period of time, okay, between the outflow of cash to pay for the materials. That means you buy the materials, okay, from a supplier, and then you buy, you keep it in your organization, store it in your warehouse as inventory, and then you sell it to your customer. Okay, so after you sell it to your customer, there will be a time where your customer pay you after their credit period. Okay, so the cash operating cycle is the time or the point where your money goes out from the company and then you get back the money within a certain period. Okay, so why are we not including cash in the cash operating cycle? Because here we are actually calculating how many days it takes for us to get our cash. So that's why here the objective of the calculation is to calculate the cash, how many days it will take to get back your cash. So cash should not be included in the cash operating cycle. So do not get confused. The major problem with students here is they get confused between the formula of working capital and the cash operating cycle. The main difference is that your cash operating cycle is shown in number of days, whilst your formula, your working capital, or the calculation of your net working capital is expressed in monetary value. So that is the main difference you need to know, you need to take note, you cannot get confused. Okay, so what is the formula for cash operating cycle? It is receivable days plus inventory days minus payable days. Effectively, it is similar as current asset minus current liabilities. You just don't include the cash inside. Now, when you are calculating the cash operating cycle, when you express it in the number of days, okay, my question to you, is a higher number of days better or a lower number of days generally better? Generally.
It depends on the industry.
Sorry?
I would say it depends on the industry.
I'm saying generally. Do not take into account the industry. Do not take into account the risk. Do not take into account anything.
Then the lower will be better, right?
Yeah, the lower will be better because you are receiving your cash faster than you expected. So if your cash operating cycle is 30 days, that means from the time where you spend your money until the time your customer pay you, it's only 30 days. That means you receive your cash that you have spent within 30 days. That's fast. That's great. That's good for your company. That means you are able to manage the liquidity of your company well. Okay. If it is higher, let's say if it's 90 days, that means what then happens? What is the impact to the organization? The impact to the organization is if your cash operating cycle is higher, what happens? You would then have to source for alternative sources of funds to run your organization, because for that 90-day gap, you do not have enough money. You are not getting back the money. So you have to fund it for a longer period, so you pay a higher interest, because obviously if you do not have sufficient funds for 90 days, you're definitely going to borrow from the outside, whether it's long-term or short-term, that depends on the company. Okay, but the reality is the moment you borrow from external parties, from the bank, okay, or a personal loan, whatever it is, you would have to pay interest. Okay, similarly, if you have only a 30 days gap, within that 30 days, you would take on a short-term borrowing and you have to pay lesser interest. So the impact on your company, if you have lesser days, is better. Okay, now going back to what your friend said, it depends on the industry. What does it mean? Okay, that means not every industry has the same cash operating cycle. every industry is different. There are even industries that have a negative cash operating cycle. What it means by negative cash operating cycle? Okay, that's my first question, sorry. My second question is, what does it mean by a negative cash operating cycle? And how does a negative cash operating cycle help your organization? Anyone? For some reason, I'm sitting under the aircon, but I'm like so warm. I'm feeling so warm. I don't know if the weather is just hot or what.
Is it negative because they don't have any receivables?
Is it negative because they don't have any receivables? Okay, it is usually negative. I don't know how to correct your answer because it's right, but the concept of it is not correct. Okay. The fact that you have a negative cash operating cycle means that you receive money even before you require to pay out that money. Okay, so usually this happens in a retail business. Okay, because in a retail business you have a negative outflow. Okay, and you receive the cash immediately, okay, from your customers. You know, they pay you on a cash basis, so you receive the money before you even need to settle your obligation. Okay, so how is it good? Because you have sufficient cash flow to run your day-to-day organization. Okay, now on average, okay, you can never say which is the best cash operating cycle. So number one, you need to remember your examiner will never ask you which cash operating cycle is better. He will never ask you that. So he will never ask you to compare one another, but he will give you one organization, one company, and he will ask you to make a comparison, okay, from last year to this year. So if it's the same organization, then you will know that if it is decreasing, it is better because your organization is then managing the cash more efficiently. Okay, so when you talk about cash operating cycle also, besides the industry, there are many other factors that affects your cash operating cycle. Example, the risk of the organization, the availability of funds of the organization, all those things, their credit terms, all these things will also affect the cash operating cycle of the company. So it depends completely, not only on the industry, but also on the company, on whether they have effective, efficient working capital cycle. Okay, now let's quickly do a short question. Okay, so I don't think you guys have this, and it's rather small, so I would recommend you to look at the question on your own screen. Okay, I'll try and make it a little bit bigger. Yeah, but excuse me if I suddenly accidentally switch to the next page. It happens a lot during my classes. Okay, now, so for this question, I'm going to do a working capital cycle or cash operating cycle question. Just the calculation, just for you to be familiar with how to do it, just for you to have the confidence to do it. Okay, so remember, the first thing that you need to remember whenever I say cash operating cycle or working capital cycle, in your mind is number of days. It cannot be anything else. Okay, so when you talk about number of days, then by default, your individual formula should also be in number of days. So in this question, for the change in working capital policy, calculate the change in the operating cycle. So I'm going to only do this part of the question, okay, because I'm focusing on cash operating cycle. So whenever he said change, okay, now this you need to remember, not only for this question, but for any other type of questions. Whenever he say change, what that means is there must be a before, there must be an after. Whenever he say implication, there must be a before, there must be a after. Because if you don't have a before and after, how are you going to monitor the changes? Okay, so in my mind, whenever I say change, it will be before and after. Okay, and then he said calculate the cash operating cycle. So I'm going to skip the rest because this is not in our view today. And he said comment on your findings. Okay, so cash operating cycle is trade receivable days plus inventory days minus trade payable days. Okay, now, and when he asks you to comment on your finding, the final answer, you need to explain more in detail. Okay. Now, let's read his question together and we identify what is required. So, TGA, a multinational company, has annual credit sales of 5.4 million. Related cost of sales are 2.16 million. So, he has given you the credit sales and also the cost of sales. Now, approximately half of all credit sales are export to a European company, which are invoiced in euros. Financial information relating to TGA are as follows. So he has given you a financial information here. So the fact that he give you a financial information, again, it's not just for working capital, it's across all questions. The fact that you have a financial information, definitely there will be calculation somewhere along the question. Let's say it is a full theory question. He give you 10 marks and all 10 marks is theory, but he gave you financial information. Do you think you need to do any calculation? Definitely you have to. Okay, definitely you have to. That means your calculation will be part of your explanation. Okay, now back to the question. TGA plans to change the working capital policy in order to improve its profitability. The policy change will not affect, so he will not affect the current level of credit sales, cost of sales, or net working capital. As a result of the policy change, the working capital values are expected to be as follows. So this one is as a result of the policy change. That means after the change. Okay, now other information given. Okay, this, okay, this is not relevant to us. Okay, the one that is relevant is there are 365 days in a year. Okay, this is something that you need to remember. Do not get fooled by examiner. Examiner is very smart. ACCA examiner is extremely smart. You know why? He will ensure that you are confused, you are misleaded, you are misguided before he lets you answer the question, right? So the one way where he misleads, he misguides you is the number of days here. Most of the question, he uses 365 days. There are some questions, you must remember, he uses 360 days. Do not fall for him. You check first whether it is 365 or 360. Trust me, I am telling you now, you're going to be like, seriously, this is something that you need to tell me. But I've had students who fail my mock exams, who fail my progress test because of this 0.5 or 1 mark. I always tell my students this, your objective is to pass the paper. To pass the paper, you need only 50 marks. You cannot afford careless mistakes. You do not want to miss out on easy marks. This is an easy mark. This is right in front of your eyes. It's just slapped on your face like that. But you don't see it. Because, you know, the problem is that you guys are too used to doing practice questions by yourself that always give you 365 days. And when examiner gives you 360 days, By default, your mind says 365 days. You will accidentally write it as 365 days. So that is where you will get it wrong. So you have to be very careful of that. Okay. Now, assuming examiner did not say 360 days or 365 days, what do? Normally, I always tell my students, by default, you assume that it is 365 days. To be safe, in your examination, in the answer, you do all your calculations. At the end of the calculation, you just write a mini assumption there. You just say, assume that there are 365 days in a year. You just write that to be safe. So examiner will know where are you coming from, will understand the depth of your knowledge. Okay. So now to answer this question, okay, normally what I will do is I will have a specific format for myself. So when I do my cash operating cycle, sorry, my handwriting. Okay, I always do it downwards. So I always do my trade receivable days, my inventory days, and trade payable days. Okay, there is something that you need to remember here. There is a reason why I do it downwards, because assuming you need to make a comparison before and after. So here will be before, and here will be after. Okay, and I will leave, after I write my trade receivable days, I will leave 3 to 4 lines. Okay, remember, you guys are doing CBE. Okay, so if CBE, you can just, as long as you put the formula inside your cell, no issue. I've taught CBE students, CBE is so much more easier than writing down, okay, on paper. Trust me, once you have enough practice, your life becomes easy. CBE is so much easier than doing the real paper-based exam because the risk of error is lower. Calculation error risk is lower. All you need to do is you need to practice so that you get a hang of it. Okay. Now, so my trade receivable days, okay, before, okay, here someone needs to help me to do the calculation because I don't have a calculator with me. Okay, so my trade receivables is 1331.5. If this is after, this is definitely before, because normally the financial information is current information unless otherwise stated. That means normally when he gives you a financial information, it is a current information. Normally, he even will write here the current financial information relating to the company. Okay, so you need to be a bit more careful about that. So 1331.5, trade receivable days 1331.5. I remember from memory my credit sales is 5,400, multiply 365. Okay, and then my inventory days, my inventory balance here. Okay, so the formula for inventory is inventory over cost of sales, 473 or 413, 473.4, 473.4 over 2160, multiply 365. And then your trade payable days, okay, sorry, I don't have enough space here. 177.5 over cost of sales 2160, multiply by 365. So can you please give me the number of days before in the chat box? I'm fine. Help me, I don't have a calculator. Don't leave me stranding here, please. Trade receivable 90 days. 90, 80, 30. Okay, thank you very much. Now, I want to give you another reminder because you guys are doing CBE. Okay, if you do paper-based calculation, normally you just take your calculator, 90 plus 80 minus 30. Very easy, simple. But when you do a CBE paper, normally you will tend to use the sum function. Okay, so if you use the sum function, the problem is that if this is positive, it will add up everything together for you. So you must be very careful. When you put in the 30, right, you put it as negative in your Excel sheet or in your ACCA practice website. Okay, so that when you use the sum function, you get the right answer. You don't want to miss out 1 mark or 0.5 marks simply because of a careless mistake. One negative sign is 0.5 marks, effectively 1 mark. Okay, so that is a problem. Now, 8, 16, 17 minus 340. Okay, correct me if I'm wrong. I'm using memory. Okay. Now, to find the days after, 50 days, 62 days, 45 days. Okay, 50, 62, 45. So I would recommend you, whenever you are doing your practice, make sure you write the bracket here. Okay, so that you avoid, we want to avoid easy careless mistake. Really, that is the biggest thing that makes a student fail. You know, in this paper, in a F paper level, there are a lot of students who fail 48, 49, 50. Sorry, that is 50 is not a fail. 47, 48, 49. So why is it that you fail 47, 48, 49? Because your main reason is careless mistake. Try your best to avoid careless mistake because knowledge is there. If you don't have knowledge, you cannot get 48. You cannot get 47. What you want to do is you want to be able to be on point when you do. So, yep. How many days is this? 112, 762.
67.
67, sorry, thank you, 67 days. Okay, so now you need to comment. So you see there is a reduction, okay? Now, if I were to let you comment by yourself, what would your comment have been? Maybe you want to post it in the chat box so that I can see whether you guys are in the right track. Nobody's judging anybody here. We just want to see whether everyone is in the right track, that's all. So maybe 1 or 2 of you can post your answer if you're confident enough. It's okay. There isn't anybody who's going to judge you or say something about your answer. What will your comment be? I'm assuming you're taking time because you're typing. If that's a fair assumption. Okay, starting with the meaning, okay, of working capital cycle. How do you continue? Because you need to comment on the changes, right, before and after. So by just starting with the meaning, you are not actually answering his question. So how do you answer his question? Comment on your findings. Your findings is that the number of days has reduced. The cash operating cycle is improving. Yes, you can do that. Followed by the reason of the reduction in number of days. Okay, comparing both of the results. Okay, so now actually Afan Hazik, your answer is correct, but you need to be a bit careful of time, because if you talk about one by one, you may lose out time, because here I think your question is just 8 marks only, okay? So you don't actually get that many marks for commenting. You get about 1 or 2 marks for commenting. So I would say the best answer that you can give your examiner when he say comment on your findings, you tell him that the working capital cycle has reduced by, oh sorry, my handwriting is a bit ugly, by X number of days. So you minus formula, okay? X number of days, which is indicative that the new policy implementation is working, hence increasing efficiency of working capital management. I'm just going to say WCM. Okay, easy, 1 mark, you get full marks. You don't need to negotiate with examiner. You gave him what you want, you get your full marks. This is a cash operating cycle. It's a very simple question. Another question relating to cash operating cycle that I may want you to try. Let's see, maybe I'll give you a 5 minutes break to try it. Okay. It is a backward calculation, okay, of the working capital cycle. That means they don't directly give you the figures. Here they directly give you the figures. But that question, they don't directly give you the figures. They ask you to calculate backwards. The question name is FLG Co. I think it's a December 2008 question. I will double check this for you in a bit. Okay, so far, anyone has any questions? Are you guys good? You need me to explain anything for you at this point? Okay, I assume silence means no.
Miss.
Yes.
I'm not really, I don't really understand the part where the negative cash operating cycle, what does it actually mean?
Okay, when you talk
I'm not really clear about it.
Okay, when you talk about a negative cash operating cycle, that means normally, right, the reason why your cash operating cycle here is reducing, okay, if you look at the figures here, is because your current asset is reducing and your current liabilities are increasing, okay. If you just look at it on the surface without looking at any values, normally a negative cash operating cycle, you need to know what it means, okay. It means that you are receiving cash faster than you expect to receive. That means you are getting all the money faster than you expect to receive. So I have this one question and answer that I can give to you. I cannot remember where I kept it. If you don't mind, then maybe when I give you a break later, I will look for it for you. It explains the negative working capital cycle very well. It is part of your passive question. Your examiner has asked you about the negative working capital cycle before, but what you need to remember is this. Just keep this in mind. A negative working capital cycle means you are receiving cash faster than you require the money. So now what you have to do is only to pay your payables. Okay. Normally, like I said, the example should actually help you to understand it better, because if you look at the retail services, you are receiving the cash faster than you need, because people are paying you the money immediately. They are paying you, so they don't owe you anything. There isn't any balance. The balance here is 0, 0, 0. So because the balance here is 0, or maybe you have some inventory balance, but your customer balance definitely is 0 because nobody owes you anything. Okay, so if your inventory days is lower than your payable days, that means you have enough or sufficient cash, and the next thing that you need to do is only pay your payables. You have received all the money already. What is left is just to pay the money to your trade payables. That's why it's a negative, because the only thing left or the only thing owing is the trade payable days. Nobody else. That means your customers are not owing you anymore. You owe somebody something. You have received all the money. All that is left for you to do is make a payment and settle the liability. Are you okay? Is it better now?
Yes, miss. Yes, understand, miss. Thank you.
Okay, welcome. Okay, let's move on to the next part. Okay, so for this class, I cannot go through overtrading because overtrading is one whole topic by itself. So I'm going to skip overtrading. And I'm going to move into working capital management. Okay. So when I say working capital management, then you're going to ask me, Miss, didn't you just say that this whole topic is working capital management? Yes. When I say working capital management, I mean by managing the individual elements of working capital. What are the individual elements of working capital? Current asset, current liability, trade receivable, trade payable, inventory, and cash. Okay. But we will not touch cash on this chapter. Okay. Cash will be a separate chapter by itself, working capital financing. So we will not talk about cash at all. We are going to just touch into the inventories, trade receivables, and trade payables. Okay. Now, when you are managing the working capital elements, what are your objectives? So that is the first thing that you need to know, because if you know this one thing, the first thing, you understand your objective, then you will understand how to move forward. Okay, so when I talk about inventories, managing inventories, what is my objective? Okay, my objective is that I would want to reduce the total annual inventory cost. Okay, so just a very small pop quiz. Does anyone here know what makes up to the total annual inventory cost? What are the elements of total annual inventory cost? Anyone?
Procurement cost,
Sorry?
holding cost, and ordering cost.
Okay. I call it the HOP: holding costs, ordering costs, purchase costs. Okay. So these are the elements of your total annual inventory costs. Okay. Now, in order for me to be able to reduce the total annual inventory cost, I need to first reduce these individual elements or these individual costs. Then I will be able to reduce the total annual inventory cost. Okay, so bearing in mind that you have total annual inventory cost, there is a method that you can use also. Okay, there are multiple methods that you can use. Okay, but one method that we will go or dwell into the details for our ACCA FM paper will be the Eoq method, because the Eoq method assumes that you will be able to manage your cost effectively if you follow the model. Why? Okay, why, we will talk about it in a while. Okay, so what Eoq means is economic order quantity. The name itself shows you so many things, so many elements that is already in the name. Economic order quantity. So it means that you order at a quantity that is economical to your company. That means economical means cost saving and cost reduction. Okay. So when you talk about the economic order quantity, you follow this formula, 2 COD over CH, whereby CO is your cost of ordering, D is your demand, CH is your cost of holding. Now, after you have found the EOQ, value of Q, that means this value of Q is the amount that you need to order in order for you to be able to reduce costs. Okay, now you need to understand EOQ model or any kind of model that is developed by people, actually these models have assumptions, and because of the assumptions sometimes it can be deemed as unrealistic, but to a certain extent you still can use it. Okay, just that some parts are unrealistic, which you can tweak it according to your own requirement of your company. Okay, so the EOQ model, okay, I have 1, 2, 3 steps for you. Okay, once you have used the EOQ formula to find the value of Q, okay, you need to find the total annual inventory cost. So my recommended approach for you will be, number 1, find the value of Q. Using the EOQ method. Because examiner will let you know, he will tell you, use the EOQ model to calculate the total annual inventory cost. He will tell you. So the moment he say use EOQ, then you know the first step, the first thing you can never miss is to find the value of Q. Okay. Then number 2, calculate the holding cost. Holding cost, and then you calculate the ordering cost, and you calculate the purchase cost. Okay. I will try to do it as detailed as possible because there are many elements that you have to incorporate into this EOQ model actually. But let's see how much time we have. Okay. Now, after you find the value of Q, okay, you need to know the individual formulas. So the holding cost, the formula will be Q over 2 multiplied by CH. The ordering cost will be demand over Q multiplied by CO, and the purchase cost will be demand multiplied by purchase price. Okay. Now, when you use the EOQ model, you need to remember a few things. Okay. Number 1, please don't forget the square root. Okay, I have students who actually forget the square root until when they use their calculator, they are like, wow, the number's so big. Then, oh, I forgot the square root. Okay, that's number 1. Number 2, the most important thing that you cannot forget is your demand. Your demand has to be expressed on an annual basis. Okay. When I say annual, that means I'm already coming to something, right? That means your examiner, to ensure that you are misguided, what he will do is he will give you monthly figures. And when he give you monthly figures, you know what happened? You just see a value, you so happily just take the value, put it into your formula, you finish the whole thing and you realize the whole thing is wrong. Okay? Now, whenever the examiner gives you a demand value, the first thing you check whether it is annual or not. Because demand can be monthly, can be weekly as well. So, if it is monthly, you multiply by 12. If it is weekly, okay, I'm just going to write this down. If it is monthly, you multiply by 12. If it is weekly, the first thing that you do, you need to check whether the examiner gave you the number of weeks. If he gave you 50 weeks, you use 50 weeks. If he gave you 52 weeks, you use 52 weeks. If he don't give you anything, you assume it is 52 weeks. Okay, this is something you cannot forget. This is also a common mistake by students. You know the funny part about when I teach students, okay, when I tell you these kind of little things, the funny part is I've taught students before who roll their eyes at me, this kind of thing also you tell me. Sarcasm, you know, literally in front of my face, sarcasm. I say, okay lah, never mind, you laugh at me now. when the exam results come out, I will laugh back at you because you never listen to me. You end up, you got the marks that you do not deserve just because of arrogance. Okay, so remember, these kind of things are those little things that when you accumulate, actually it's quite significant. Okay, so once you have calculated, okay, so now you know your demand has to be annual, your CH is given, your CO is given, and then you find the value of Q. Then you take this value of Q that you have calculated, you incorporate it into the holding cost formula. Okay, I've got two formulas to give you actually for holding costs. Okay, the first one, the normal one, Q over 2 multiplied by CH. The objective of calculating Q over 2 is because you want to find the average inventory. Average. I hope you can see this. What it means is by average inventory. Now, I've got a question, a very interesting question for you. Why is it that when I calculate the average inventory, how come I didn't opening plus closing divide by 2? Why I just take Q over 2? Anybody got that answer for me? I repeat my question. How come I didn't take opening plus closing divided by 2? Because logically, right, if I think average inventory, opening plus closing divided by 2 is average. But now, I only said Q over 2. Why?
Miss, excuse me, but isn't the formula is the other formula for average inventory? The starting plus closing, right?
Sorry, I don't understand what you just said. Isn't it?
Okay, isn't the formula of starting inventory over closing inventory over with 2 the other formula for average inventory?
Also, so now, okay, I understand your question. So now you mean that there are two different inventory, average inventory calculation. One is opening plus closing divided by 2, and another one is Q over 2. Is that what you mean?
Yeah, man. Yeah, miss, exactly.
Okay. Okay, your answer actually, it's not two different formula. Actually, effectively, it's the same formula. Okay, I'm going to explain it why. Because, why I cannot write here. Okay, because you assume your starting inventory is Q, and because you use the Eoq model, you assume that at the end of the period, your inventory will fall to 0. So your closing inventory value is 0. So effectively, if I want to calculate average inventory, Q plus 0 over 2 is Q over 2. Okay, so actually it is the same formula, opening plus closing divided by 2. The only difference is that my Q is my opening, my closing inventory, because I use the EOQ system, I assume it will fall to 0. That's why it's Q plus 0 over 2. Okay. Multiply by CH. Okay. Now, I'm going to ask you another question. How if I have buffer inventory? How will my formula change?
Just plus the buffer with Q over 2, right?
Okay. Do you plus it Q plus buffer over 2 or you plus the buffer outside?
We divide it first, then
Okay, divide
we
it
plus
first.
it.
And then you plus. Okay, correct. Your answer is correct. Okay, now why is it that I divide first and then I plus? What is the logic? The formula is, I'm just going to write the formula, Q over 2 plus B multiply by CH. Okay, sorry, this can't be seen, but I think you understand what I mean. Why do I have to Q over 2 plus B? Why don't I plus Q plus B over 2? Anybody? Want to try? If not, then I'll just give you the answer. No, yes? Okay, silence, I feel, or I think silence means you're not so sure. Okay, the reason why you plus the B outside, okay, you must remember Q over 2 is average inventory. Okay, when they give you a buffer inventory, let's say the buffer inventory per month is 1000 units. Okay, so I will just Q over 2 plus 1000 and then I'll multiply by CH. But why I multiply by 1000? Isn't that per month? Okay, you must remember, even though it's per month, it is also the average inventory value. Why do I say that? Is because, okay, the logic is 1000 per month. Okay, I multiply by 12, I divide by 12, average inventory is still 1000, correct? So on average, every month I hold 1000 units. So that is an average value already. That's why I plus it outside. Okay. Now for the next one, ordering cost. Demand over Q is to find the number of orders. Demand over Q multiply the cost per order, because the CO is the cost you incur every time you make an order. So you first need to find how many orders do I make. To find that number of orders, my total demand, let's say it's 60,000. I order 12,000 at one time. My Q value is 12,000. So how many units do I order? I think it's 5. How many times do I order? I think it's 5. Okay. So 5 orders I make. Each order costs me, let's say 200. So 5 times 200. So the logic is I first need to find the number of orders, then I multiply by CO. And then my purchase price will be just the demand multiplied by purchase price. For this calculation, I have not included the variation of a discount yet. Okay, that means there is a variation for you to get a discount. But before that, I want to write down the formula properly. Okay. Okay, before I do the formula, I need to explain one more thing. Okay, this is using the EOQ, the one that I just taught you. Okay, your examiner has a very common question that he normally asks. What is the question that he asks? Okay, so the company will have its current traditional ordering policy, meaning they don't follow the EOQ. They have their own way to make orders for the inventory. Okay, and what the examiner will do is he will say, but they now want to introduce the Eoq model. So he has a traditional ordering policy, traditional ordering policy. He will ask you to compare it with the Eoq model. Okay, so what you do is, okay, you use the same format for both calculation. I give you an example. Your format will be Q, holding cost, ordering cost, purchase cost, and then total annual inventory cost. Okay, now here will be the traditional method. Here will be the EOQ method. Why I asked you to do it this way is because now the traditional method, the Q, he will just give you a figure. He will say on a monthly basis, the company orders 10,000 units. That means it's already given in the question. So put a note to yourself. For the traditional method, Q is given in the question. Value of Q is given. And then when you make a comparison with EOQ, value of Q, you need to calculate. Okay, so these are the most important things that you need to know. Okay, and then, okay, so you must remember, after that, when you are doing the traditional method, Q over 2 multiplied by CH, demand over Q multiplied by CO, demand multiplied by purchase cost, and then you add up all together. The Q that you use here is the Q that is given in the question. For this side, Q over 2 multiplied by CH, demand over Q multiplied by CO. This Q, you get it from the Eoq model. Please write yourself that note. Okay? And then you will total up everything together. The decision rule is you always choose the decision where the total annual inventory cost is the lowest. Okay, I'm gonna write it here. Decision rule. Choose the total inventory cost that is the lowest. So when you calculate the value here and when you calculate the value using the Eoq, you choose the one which is the lowest. You must comment. That means you must write. The company should choose the Eoq method because the total annual inventory cost is lower than the traditional method by how much? Okay, I'm going to write that down also. The company should choose the Eoq model or method, whichever, okay, as the total annual inventory cost is lower than the traditional method by, you must tell the amount, X amount. This one you can use across all questions. Whichever question that you're doing, as long as they ask you to make a comparison, you can use this comment. You can use a very generic comment because if you want to keep remembering so many different things, it's going to make your life difficult. So I always tell my students, either you already know how to do it by yourself, that means you are familiar on commenting and writing, or if you're not familiar, you use this. So we want to cater everyone, all my students. So I will give this, whoever wants to use this, you can. If you don't want to use this, then you can use your own method, okay? Okay. Now, so here I've got an example. Oh, it's June 2008, not December 2008. So, for this question, FLG Co, June 2008, if you have your own question, it would be good, okay? He asked me to calculate the total cost of inventory for the raw material using the Eoq method. So here in this question, he did not ask me to make a comparison. I just need to calculate the total cost of inventory. When I say total cost of inventory, that means it is my total annual inventory cost. Okay, now, so when I want to use this method, when I see Eoq, I must, in my mind, I must know 2COD over CH, okay, to find the value of Q. So now let's read his question and identify. FLG wishes to minimize its inventory cost. So you can see, right, every time he say that he wants to use the Eoq or he wants to change the method of accounting for inventory, sorry, I just froze for a while. Okay, method of changing the inventory. What you need to understand is that his ultimate objective is memang to minimize cost. It's always to minimize cost. That is his ultimate objective. Okay, now the demand for the raw material costing $12 per unit. So this is my purchase price. I'm just going to say PP is 60,000 units per year. So this is demand that he expressed in annual terms. Inventory management costs for these raw materials are as follows. So he gave you the ordering cost, he gave you the holding cost. The supplier of this raw material has offered a bulk purchase discount of 1% for orders of 10,000 units or more. So this bulk purchase discount is not relevant to us. So I'm going to skip reading this because this, I'm just going to put a note for you so that life becomes easy for you. This one is bulk purchase discount. Okay, so you can try this question by yourself later. Okay, now to calculate the total annual inventory cost, okay, let's first find the value of Q. So I'm going to follow my steps. Q equals to 2, CO is cost of ordering 6, demand 60,000 over 0.5 square root. Can someone please help me? I don't have a calculator. $1,200. Sorry guys. 1,200. Okay, so this is my value of Q. This is in number of units. Then I need to find HOP. So my holding cost is 1,200 over 2 multiplied by CH is 0.5. 600 0.5, is it 300? Yeah, okay. And then I have ordering cost, O, number of orders, demand 60,000, 60,000 over 1,200. Is it 50 orders? Multiply by 6. Okay. This is something that a lecturer will know. The answer should be the same. Normally, if no buffer inventory, okay, it's just no other discounts, no buffer, nothing. How you know whether your answer is correct? Your H and O has to be the same value. Okay. This one I'm not going to tell you why, because it's something to do with how they develop the formula. Okay. It's not even required or necessary for you. Yeah. And then my P is 60,000 multiply 60,000 multiplied by 12. This one is 720,000. Okay. Is it 720,000 or 72? 720 betul. Okay. So when you do it downwards. Okay, I don't have enough space. So my total annual inventory cost is 720,600. Okay. It would be good if you guys can look at a question that shows the difference between the traditional method and also your Eoq method. So I'm going to give you that question. Just give me 1 second. Oh, sorry, 1 second, tak jadi. Where is it? I have it here with me actually. You can try question. I don't want this. Maybe I'll try to see this. This one looks better. You can try question. Lama, I don't know which year is this. Okay, maybe you can take down the name of the question. And then you can find it, which year it belongs to. The question is WQZ. Cool. This question is a question that compares the EOQ with the current ordering policy. Okay. Okay, so far, any questions? Okay, if silence means no. Okay, I just want to remind you that I'm going to about 5:45. I'm going to stop to open for Q&A, and then I will have a few things to let you know. Okay. Now back to our notes. So if you are familiar with Eoq model, you are familiar with the format, you know how to calculate. So actually, like I told you, as long as you have a format to follow, as long as you have a method to use, a direction for the examination, then your life becomes easy. Passing the paper is really, really not difficult. Trust me, I have gotten 100% passing rate for an FM or F9 paper. 100% of my students pass the paper. So it is not difficult for you to pass. If you pass, it's your effort. I give it back all to my students, 100% pass, because they put in sufficient effort and they listen to me closely in class. They ask for guidance. So you should go to your lecturer and ask them for guidance whenever you require guidance. Okay. Now, if you already know how to use the Eoq method, if you already know how to compare with the company's traditional or current ordering policy, so what you then need to know is that there are also other methods that you can do. The JIT method. So maybe you can read this by yourself, because those are things that you have learned over the years. So I'm not going to teach you this JIT, just-in-time system. And then you need to know what are the disadvantages of the Eoq model. Okay. So one of the disadvantage of the Eoq model that I think I need to tell you is that, number one, it does not account for any sort of discounts, but you can incorporate the discounts in your calculation whenever you require. Okay. And then number two, you assume that there is no lead time. What is lead time? Oh my God. Anyone? Oops. What is lead time? I'm sure you know what is lead time, because there is one question in the ACCA F9 that is quite difficult, the Eoq model. This one, you must try it by yourself. Why is it difficult? Because the question does not give you the buffer inventory. You have to calculate it yourself. Okay, so because you have to calculate it yourself, you need to know the formula. Reorder level multiplied by the minus the lead time. Okay, so this is something that you need to know. So you need to know what is lead time. If you guys are from the CAT background, you probably would have done it in your FMA or FFM paper. Okay, anyone wants to answer me what is lead time? See, I'm looking far away. Hopefully I can see you, but I can't. No? Okay, lead time is the time between when you make an order and you receive an order. So normally, let's say today Lazada 10/10 shopping, 10/10 promotion, sorry, not shopping. So you guys go and do a lot of shopping. So if you put the order in today, you will take at least 1 to 2 weeks to receive your orders, right? So that is your lead time is 2 weeks. Okay, now the Eoq model, it assumes that there is no gap or no time in between when you make an order and receive. That means they assume when you make the order, you immediately receive. Not logical, right? Not realistic. So the more realistic method is to have a buffer inventory in your organization, because the model assumes no lead time. All right. Now, so look into the disadvantages. You need to know the disadvantages. Another thing that you need to know when you talk about JIT, you need to know what is the meaning of hidden cost lah. Okay. Why am I telling you all this? Because these are the terms that you can use when you write your answer in the section C, the structured area. Okay, now for the next part, okay, I'm going to tell you beforehand, the trade receivables, okay, there is a larger part to the trade receivables, meaning number one, you need to ascertain the objective. Number two, you need to know what is the process that you go through in setting up and a trade receivable management system. Okay, and then number three, you have early settlement discount, you have change in credit period, and then you also have factoring and invoice discounting. I'm just going to write it down in case today we cannot finish it, then you know where you need to go and learn, or which one you need to study. Okay, so here before this, you need to know the trade receivable policy setting. There are 4 steps here. And then early settlement discount, changes in credit period, factoring, invoice discounting, Okay, now I'm going to just write for you what are the 4 steps. Okay, so the first step will be to establish a receivable policy. Let me just get a new page. Okay, when you talk about the trade receivable policy, four steps. Number one, I forgot what did I say again? Establishing a receivable policy. Okay. Okay, I actually did not intend to go through this, but I think it will be good for you. It will be something that is beneficial for you. So when you talk about the policy, you are talking about what are the terms that you want to offer to your trade receivables. So what are the terms to offer? Okay, and then step number 2 will be for you to set up a credit analysis system. Okay, establish a credit analysis system. Okay, what a credit analysis system is, what do you do when you analyze the customer's credit worthiness? You will check from the references, and also you will perform credit analysis. So you will look for references. So what are the types of references that you have?
Credit references.
Okay, credit references, that means you can go to credit agencies, you can go to their customers, you can go to their suppliers, you can ask from the banks. Okay, credit analysis. When you credit analysis means you are trying to find out information on how much credit would be suitable for this particular customer. Okay, and then step number 3 would be credit control system. Control system. At this point, what you would do is you would review the credit limit, Okay, and then your final step would be the debt collection system. So debt collection. During a debt collection, what you will do is you will send reminders. Okay. You will call, you will talk to them, you will send out the statement, ensure that they pay, encourage them to pay, and if they don't, the final thing you do is you go to the lawyers, okay? Or you can also send out statements. Sorry, I cannot multitask. Statements. And then finally, what you can do is you can use a factor services. Okay, so for your ACCA FM, factor is one significant area. Okay, your examiner will ask you many things about a factor services. Okay, yeah, it's about whether you know how to explain to him and whether you know how to do a calculation or not. Okay, now the next one, after you have set up the policy, okay, will be early settlement discount, change in credit policy, and factoring. Now, the objective for you, why you want to set a policy, is because you want to be able to ascertain what is the optimum level of credit that you can offer to customers. And you also want to be able to effectively and efficiently manage that credit. Okay, so because of that, you will set up the policy for your trade receivable, and following to that, you will try to find methods in how you can get your trade receivable to pay you faster. Okay, not only pay you faster, but also you want to at the same time be able to manage the relationship with your trade receivable at the same time. Okay, now when you talk about early settlement discount, what is the concept of early settlement discount? The concept of early settlement discount is as clear as the name is. You give a discount to your customer in order for them to pay you faster, okay? And you want to be able to manage the cash flow within your company, okay? So early settlement, oh my God. Early settlement discount, I have a question that we can do together. Early settlement discount is a discount given to customers to enable customers to pay before the credit period. Okay, so when you talk about giving them a discount, so what it also means is that the discount that you are giving to your customers is a cost to your company. So what you want to do is that you want to see, if I give my customer an early settlement discount, is it actually beneficial to my company? Yes or no? So in order for you to check whether it's beneficial to your company, you will do a cost benefit analysis. Now, what is a cost benefit analysis? A cost benefit analysis is you are weighing the cost that you have to incur as opposed to the benefit that you are going to receive. So now, the cost that you incur for the early settlement discount is the cost of discount. You need to bear that cost of discount because you give them a certain amount of leeway. Reduce the cost for them, you bear the cost. Now, what is the benefit that arises from an early settlement discount?
Reduce in overdraft usage.
Okay.
Interest.
Yes, interest. I was waiting for that word interest. Okay, so the more accurate version is the more accurate way of saying it is reduction in interest payments. Okay, the logic of it is, okay, now you give your customer a 30-day credit period. That means for 30 days, They owe you a certain amount of money. They are not paying you. You don't have that money because they're supposed to pay you, but for 30 days, you don't have that money and they're not giving it to you. So for that period of 30 days or longer, because 30 days is the credit period, sometimes they even pay after. So 90 days, 120 days, okay? And to a certain extent, there are times where you need to write it off as a bad debt as well, okay? So 30 days, okay? Or 60 days or longer, okay? What happens is that because your company is not receiving money from the customers, so what you have to do is you have to go outside to source the money from external parties. So example, maybe you use an overdraft from the bank, external party bank, you get an overdraft from him. Overdraft, or you can take a short-term loan, okay? You can take any sort of borrowing. The fact that you need to borrow money from the outside. When I say the outside means outside of your organization, external party. You need to pay an interest cost to finance this amount of money. So the longer the customer take to pay you, the more interest you need to pay. So you want to encourage them to pay you faster so that you pay lesser interest. So the cost to you is a discount, but the benefit is the saving on interest if they pay faster. So your job is you want to outweigh whether the cost of discount is higher or lower than the benefit that you derive from the interest saved. Okay, so how do you do this? Okay, now I also got steps. Okay. I have a format actually. So early settlement discount, too long, too many things to write. So I make it shorter. So you do a cost benefit analysis. You always write all your costs first. You always write all your, up to you lah, you want to write cost on top or below, but because I call it a cost benefit analysis, so I do cost on top, benefit below. Now, your cost, you know it's a discount. And definitely when they pay you early, you have a interest saving. Now you need to calculate this interest saving. How do I calculate this interest saving? So what happens when you have an early settlement discount is that the receivable balance will reduce. That means before the discount and after the discount, it will reduce. Definitely the receivable balance will reduce. Why? Because there will definitely be some customers who will be inclined to take on the discount so that they get a cheaper price to pay you. Okay, so this interest saving is actually a result of the reduction in the receivable balance. So how you calculate interest saving? This is my working one. So my receivable balance before the discount and receivable balance after the discount. So X amount, if there is a reduction in trade receivable balance, then there will be a saving for my company in terms of interest. Reduction in the balance means people are paying me faster. I am getting money. So if I get money, do I need to borrow from the outside? No, I don't have to. So I reduce my borrowing, I reduce my interest payment. Okay, logic. Now, assuming before and after there is an increase in the balance, that means people are not paying you on time. Nobody take up the discount. Okay, so people are not paying you on time, so your interest will be not saved but an interest cost. So far, are you all okay? Because if you're okay, then I want to do a question. Do you have any questions yet? Okay, so I assume you don't have any questions. So let's try this question. I've prepared one question for you. December 2012, the question's name is KXPCO. So you know what you guys can do? You guys can just take this down. I mean the year and the company name, so that, yeah, you can try to do it by yourself. Okay, now let's read the examiner's requirement. Okay, calculate the net benefit or cost. See, oh my god, see, he also asked you to use a cost benefit analysis. Okay, of the proposed changes in the receivable policy and comment on your findings. Now, I want to remind you, whenever he say comment, anywhere, NPV, EOQ, trade receivable policy, whichever of it, whenever he say that you need to comment, it is 1 mark. 1 free mark for you. Let's say your calculation is wrong. It was supposed to be positive, but it happened when you calculated it wrongly, it was negative. Assuming you answer his comment, that means you reject the project because NPV is negative, you still get the 1 mark because you are explaining based on your answer. All that matters is that you answer, you comment based on the findings that you get. So if your NPV is negative, but actually it's supposed to be positive. So what you need to be well aware of, no matter what your answer is, do not forget the comment. Let's say you lost 5 marks in your NPV, you get that 1 mark. It saves you, no matter what. It's 1 mark. It may help you because you may be good at other questions. So it will definitely help you. Okay, so do not forget the commenting. Okay, now back to this question. Okay. Okay. KXP is an e-business which trades solely over the internet. In the last year, the company had sales of 15 million. All sales were on 30 days credit to commercial customers. That means the one that the company gives is 30 days. But what is the habits of the customers? You have no idea yet. Only when you read the question, you will know. Okay. Extract from the company's most recent financial position. So you see, he always give you the current information. Okay. He gave you a trade receivable balance. He gave you a trade payable balance. He gave you an overdraft balance. In order to encourage the customer to pay on time, KXP proposes to introduce, sorry, I dropped my pen. To introduce an early settlement discount of 1%. So the discount percentage is 1% for payment within 30 days. That means when they follow the credit period exactly, you get a early settlement discount, while increasing the normal credit period to 45 days. That means you want it, instead of 30 days, you want to move it to 45 days. Okay. It is expected that on average, 50% of the customers will take the discount and pay within 30 days. So out of 100% of your customers, 50% of them, they have a 30-day credit period. 30% of the customers will pay in 45 days. So 30%, 45 days. And the remaining 20% of your customer will pay at the current behavior. You don't know what is the current behavior. He said current behavior, not current credit period. Two different things. His behavior is, even though I give him 30 days, he may take however long to pay. Assuming I give you a certain amount of money, I say, hey, pay me within 5 days, but you suka hati, you take your own sweet time, you pay me after 25 days. Okay, so the behavior and the credit period is two different things. Okay, how do you find the behavior? Okay, if they never tell you what is the number of days, you find the behavior by doing backward calculation. So you can see that currently the balance is 2466. So 2466 over 15 million multiplied by 365 days. How many is that? How many days is that? Okay, 60 days. That means currently, instead of the credit period of 30 days, he is taking 60 days. So the remaining 20 people will continue to pay at 60 days. Okay, next. Okay, so this one relates to inventory. So I'm not going to read it. Okay. KXP has an overdraft facility charging interest of 6%. So this will be my interest percentage for my calculation of interest. Okay, now you have all the information. Let's try to do this question together. So my cost is definitely my discount. My benefit, oops. Interest saved, working one. Okay, now discount, simple lah. Okay, because my sales is 15 million. 50% of my customer will take the 1% discount. So 7,500. Is it 75?
75.
Okay. So remember, this is a cost, so negative. Okay, now my interest save, working one. Before, that means my current, before I implement or before I give the discount, my current balance is 2466, is it? 2466. And then after balance is, okay, you have three components, okay, your 15 million, you have 30%, sorry, I'm going to do 50% first, sorry. I do one by one. So I have 15 million multiplied by 50%. Okay, this 50% will take the 1% discount. So they will pay at 30 days. Okay. You divide by 365. Can you find for me what is the value, please?
616.
616. And then the next one are those people who take 45 days. 30% of them will take 45 days. You divide by 365. Okay, I'm just going to complete this calculation. So you give me the answer once you are done. 20% multiplied by 60 days over 365. So 6. Just now someone told me 616. Next. Is it in the chat box? 616 555 493. 555 493. So you total up for me. So this is after. That means my after, you have three parts. That means you have three different payment behaviors. Okay. So there are some people who want the discount, some people who don't want the discount. So in totality, what is my
1664.
1664. So before 2446, after 1664, so there is a reduction. When there is a reduction, how much is my reduction? This is
802.
802. Okay, so this is my reduction, and whenever there is a reduction, remember I told you that reduction in TR balance. Okay, this reduction will attract an interest saving at 6%. So 802 multiplied by 6%,
48.
48. Okay, so this is my interest save. So this is a benefit, 48. So no other cost, no other benefit. What is the net cost or net benefit?
27 net
27 net cost. Okay, so now would you recommend the early settlement discount method or not?
No.
Yes, no, right? Okay, so the early settlement discount is not financially viable as cost exceeds benefit by 27,000 or million, right? Pounds, dollars. No, 27,000. Okay. So actually it is very, very easy to do it for as long as you understand what you are doing. That is the most important thing. It's not just you just take the answer and then blindly copy. That doesn't work at all. You need to know what you are doing. And I already gave you a few formats that you can use. Okay. Yeah, if you guys have been studying with me, then you will get a lot more formats. Yeah, but if you think that this is helpful for you, okay, that you think it's something that you are able to understand, you can follow me very clearly, then you should consider to join me at my IRC this December. Okay. Okay, before I stop, do you guys have any questions at all relating to whatever we have done? I will answer any questions. I open to you guys, whatever questions that you have. Anything? Working capital management, inventory management, trade receivable management. I did not do factoring. I did not do bulk discount. Sorry, not bulk discount, change in credit period. Okay. Okay. I assume no. Okay, so
good.
So far so good. Okay, that's nice to hear. Okay, so if that's the case, then I'm happy to have you guys today. Even though it's a weekend, I'm actually very happy to have you guys today. I hope you guys enjoyed this 2-hour session. Thank you very much. I hope to see you guys faces soon. Before we end the session, I would just want to share you a promotional material, just to let you know that we have discounts for those who are looking to join our classes, our IRC. So you register with a friend, you get a $100 discount. You and your friend, both of you, you get a $100 discount. I think it's quite a significant amount. A $100 discount is actually a lot compared to the price that you guys pay. If you want to consider, yeah, I hope I can see you guys in the IRC. And also, in case you want to register for the discount, I'm just going to share the code with you, the registration code, in the chat box now. Just give me one moment. Hold on. So I've shared with you the code. Any questions, you can DM Sir Iril, or you can DM the TYMBA IG or Facebook. I don't think you guys have Facebook, okay? Or any other questions that you have, you can directly DM If you can find my IG, you can directly DM me also. Yeah, hope to see you guys soon. Have a nice day. Have a nice weekend. I hope you have enjoyed today. I enjoyed this session with you guys. Yeah, see you guys soon if I see you. Bye.
Thank you, Miss.
You're welcome.
Thank you,
See
Miss. Have a nice
Thank you,
weekend.
Miss.
you too. Thank you. How do I unshare? Oh my God.